So for Google, it's tricky. First off, Google is their current valuation is an absolute paradox. So the reason I say that is, on one hand, it looks like dead money. Opportunity cost is very real. There's some growth fears. Search is 55% of their total revenue. The AI search overhang is very real, and a multiple that refuses to budge. Doesn't matter how undervalued it is. Under 20 times earnings is that's cheap. Ladies and gentlemen, welcome to episode 16 of Investing with the Boys. It might have been a while since you've seen my pretty little face, but I'm glad I'm back. I know Sam was out last week. We had Logical kind of hold down the house with a great guest from Robinhood. A lot to unpack on this episode, the Quinceañera episode, or Sweet 16, whatever religion you guys have. I want to first pass it to you, Logical. What is your mentality about where we're at in the market and how you are maneuvering around this choppiness? Hopefully you took some, you're not motion sickness, and you can actually monitor this whiplash we're seeing back and forth.
Yeah, it's been a pretty tricky market. It's been headline driven, volatility driven. And I've just been trying to, I don't know, navigate best I can. I think everyone's kind of doing the same. So if you're kind of getting chopped around, it's okay. Everyone is getting chopped around. This guy, Trump, who I'm referring to, can just say anything he wants and just destroys the day or makes the day or whatever. But I think what's been notable in the last couple of weeks is that, we're getting bad headlines and the market isn't reacting anymore. It's shrugging it off and it's heading to the upside. And so that's why the market's been pretty resilient instead of like green to red, which is what we were seeing a few weeks ago. Or a couple of months ago, we're now seeing, red to green, which is a little bit more of a stronger market. We're seeing breadth expand. And so, yeah, I mean, we got like a Zweig breadth thrust, as they say, which typically means that 1 year forward returns are really good. There's different breadth thrust readings, so we don't know, which one's the strongest, whatever, but good signs. Obviously, a lot of people's portfolios should have bounced back if you stayed long. I'm just trying to find that happy medium right now. Me, I'm always like swinging really high, really low, constantly. And what I've been trying to get back to is back to the basics, good companies, high conviction, lowering my net exposure because I was like over 100% long, 120% long, up to 140% long, and trying to get back down to like 100% just long. Try not to do so many short things. I mean, it's tough for me to see us make new lows at this point unless we don't see any trade deals come through, or it prolongs, or the recession's worse than feared. But all those stuff, I don't want to get into macro too much. We've been doing that too much lately, and I can't wait to dive into actual businesses this episode. But yeah, I mean, just keep an eye on everything. But, hopefully we can start getting a little bit less volatility. So looking forward to that. Sam, I'll pass it to you.
Yeah, I mean, it's been a crazy year, in my opinion, ever since the new man entered the White House. And really, he's been pretty much at the helm, in my opinion, since he got voted in. We've seen crazy swings up and crazy swings down. And yeah, that's one thing that I noticed as well, is that bad news doesn't necessarily get priced into the market as aggressively as it used to. And it usually gets shrugged off and the market reacts much better to good news. So might be one of those cases where, unless we see some uncertainty come back into the market, which lately we've been seeing more certainty come back to the market. So regardless of good news or bad news, certainty is something the market likes. Uncertainty is definitely something it doesn't like. And we were at peak uncertainty in April 9. And that's when we had the infamous Trump pivot, where his Trump put came in. And that was the bond market coming to pretty much near yield highs. And after buying the dip pretty aggressively, trimmed a little bit probably last week for the first time in a while, but probably sitting at like maybe 7% cash today. But really, it's not so much just the macro headlines that are swinging the market back and forth, because I can deal with volatility in a macro sense, but we're seeing a lot of volatility in terms of individual companies and headlines, like what we saw with Google today, for example. We're recording this today on Wednesday, May 7th. FOMC day. And on the top of that, there's a lot of impact from these tariffs. It's not just macro related, but we're talking about core business impact from the tariffs and trade negotiations. So very difficult to not listen to the macro at that point. But it really makes you guys miss, like, man, I miss the times when Trump was not president and it was just the market is what it is. We're focusing on macro. Hey, let's listen to these earnings report and so on. It's like, dude, today was one of the busiest earnings days for me. Like, big holdings reported today that were not mega cap. And I honestly feel like it was so much to digest on top of that with the Google news today that at some point I just got to think to myself, how big is this position in my portfolio, and is this worth my brain power right now? Like, we all have a finite amount of mental capital, and I don't want to deplete that. As a former trader, mental capital was the most important thing, and that really never became at play as a much longer term investor when it comes to the last few years. And honestly, I've never said this before, but as an investor, my mental capital is starting to be depleted. So I have to come to those decisions where, hey, look, Google is 2.5% of my portfolio. I need to be mindful how much time I'm going to put into this. Okay. And with that being said, I'm not going to do anything in my position right now. Like, I'm not going to sell it. I'm not going to double the size or anything. I had a 10% today, but that's because I sold 10% when it was more than 10% higher. So, it is what it is, trimming, whatever. But in terms of like big moves in the position, I haven't done anything. And to be honest, this whole day, especially with App 11 reporting today, with Mercado Libre reporting today, which were amazing numbers, amazing reports, Axon reporting today, I'm going to put Mercado Libre is almost 4 times the size of my Google position. I'm going to put Google in the back seat. Okay. I'm going to wait and see what's going to happen with the litigations. And you know what? I'm just going to chill on that. And I'm going to focus on what really matters, because my mental capital, my sanity are much more important than my portfolio, in my opinion. How can I spend my money if I don't have my sanity or my mental capital? So with that being said, I'm hoping there's some more certainty back into the market. And I'm looking forward to days where we could talk about a lot of micro as far as everything goes. Go ahead, Shai.
Yeah, so a lot for me has changed in the past 2 weeks. And what has changed? I've officially stopped being a growth investor and become a commodity trader. I'm all in on gold now. I mean, I haven't been here in 2 weeks, but really my methodology hasn't changed much. And why is that? Again, I'm among this group of investing with the boys. I'm probably the one with the longest time horizon where I do the least amount of moves, because all my holdings are, there's a reason they're in my portfolio. I run a tight ship and I have a specific thesis that I'm hoping that plays out for 3 to 5 years out. So unless that thesis is breaking, I'm probably going to hold strong and maybe even add as I continue adding my cash position. But I've been quite defensive since the past 2 months or 6 weeks. Whenever the S&P and QQQ sliced through that 200-day moving average, like, I've been quite defensive. And this rally we've experienced since the April 7th bottom, like, that was a reflexive rally. That isn't anything that's going to convince my conviction that I should not be defensive anymore. And why is that? Is because this is the exact moment that we need to be I think that we should be cautious but not aggressive, because in the past bear market regimes in 2000, 2008, even some moments in 2022, like, these counter trend rallies are explosive and they look convincing right up until they run head first into the 200-day moving average. What just happened last week? We got rejected off the 200-day moving average to the dot. This isn't just a technical level in the sand. Like, this is, it's where reality sets. It's where short coverings ends. It's when macro REIT asserts itself. Like, is the foundation shaky, or is it actually solidifying that we should slice through a 200-day moving average? And then forward expectations start to matter again. Some of this macro chaos that we've been accustomed to the past 6 to 8 weeks. So, like, we got rejected off that level. So in bear markets, the 200-day almost always acts as a resistance. So we are still in a traditional correction. Like, we tested the 200-day moving average and we did not reclaim it, and it actually held with confidence, and we're in no man land essentially right now. So, like, I need to see confirmation to reclaim the 200-day moving average with volume, some follow through, leadership broadening out, which I don't think we're going to get anytime soon with unless Nvidia comes to save the day whenever they report their earnings. Like, we're just not there yet. So this is what makes now so precarious for me, because we are caught in the in between. The rally feels strong, foundation still feels shaky. Like I said, mega cap earnings were so mixed. Like, it was just, I don't remember the last earnings cycle was just that mix of a bag from among Mag 7. I think I have all my holdings, like, they're reporting really strong numbers, but the majority of them are having weak guides. Like, that is the trend. The paralysis is the word of the day for this cycle we're in right now. And you're seeing a lot of these earnings produce strong numbers, but guidance is like, ugh, kind of ugly. And it nets out and the stock really doesn't move. So, like, the real winners of this earnings cycle is actually the option sellers. That's who's been making bank. There are no gap ups, no gap downs. You can make an argument AppLovin might be one of those names that gapped up, but they have so much short FUD around it that maybe it was just a relief rally. But other than that, like, everything else is pretty flat. Like, AMD supposed to have 11% move flat. You're seeing almost all the big tech names are just essentially been flat. Like, it's just option sellers are the move this cycle.
Shy, Shy, can I cut in real quick?
Yeah.
You're talking about the chart. I was just pulling up the chart right now of SPY, the 200-day. And I was like, let me just think about this real quick. I looked at all of the Mag 7, and almost all of them are below their 200-day. And so is obviously SPY. Microsoft gapped over, has a huge gap from its earnings. Meta just reclaimed it, but also has a gap, I believe, from the earnings. But Nvidia below, Amazon below, Google below, Tesla below. It's crazy because how many growth stocks do we know today? Rubrik, Snowflake, Robinhood, Hims, all these Palantir, all of these stocks that are well above their 200 days. Isn't that an interesting dichotomy right now? Like,
there's to add on to that, also Bitcoin is just 10% away from his all-time high.
No, I mean, I shared with you guys this morning. I think it was this morning. Like, out of my top 8 holdings, all of them are in a bullish trend above the 200-day and all the key levels. The only one that's not is my top dog, Amazon. So big tech is just it's broadening out. So you might be right on that thesis, but I also think that a lot of institutions, a lot of algos, a lot of people do look at the indices at the technical level of when they get the green light that they can be aggressive. So that's the issue. Like, under the hood, things are broadening out pretty significantly. I actually don't remember the last time when the indices are just so stuck in mud, but a lot of other names that are just like showing a ton of strength. So it's an interesting time to be in 2025 for sure. But I'll let you continue. Sorry to cut you off.
So, sorry, Logical. Go ahead.
Go for it.
So my thesis, there's 2 things in play. Okay. My thesis, one, I know you agree with this, Shy, and Logical, I think you agree with it as well, and I've been pointing this out for some time, since July 2024, if you take the ratio of IGV, which is a big software ETF, divided by the SMH, which is the semiconductor ETF, that ratio has been increasing on a long-term scale. Look at the weekly chart on it. It's been going up and to the right. Maybe it has a little bit of valleys here and there, but it is literally up and to the right after vastly underperforming. That means that software has been vastly underperforming semiconductors for over 3 years. And that has had a major reversal point, which got its major push after DeepSeek. I think you guys agree with me on this, that we are heading toward the second cycle in AI, where where companies are going to start realizing on the software basis or application basis that they are actually able to see the profits and monetization of their AI products that they've been pumping CapEx into and basically taking the hit on, while semiconductor stocks have been propelling to all-time highs. Oh, go ahead.
I'm actually quite bearish on software for the next 6 months. Like, I saw this cycle.
Just software.
I just think I saw this cycle, like, nothing to show me that AI workloads are actually being quite aggressive and accelerating. Like, if you look at it, Google Cloud had really weak numbers. AWS, which essentially is the mecca for all software, because a lot of growth software is associated with AWS spend, like that was weak on the top line. You saw Datadog somewhat weak, especially if you look at their gross margins. You saw Confluent show really a ton of weakness as well. Atlassian was weak. ServiceNow, there was some fudgery that associated with ServiceNow earnings. I think a lot of Doge fear was priced into that stock entering that print, but you saw their government side of the business actually report 30% growth, so they caught a bid from that FUD. But really, it wasn't a exceptional quarter. Like, I think it's going to be tough for the next 3 to 6 months in this macro environment for software. I think that baton being transferred from stage 1 to stage 2, very real. It's inevitable. I think this tariff war delayed that 1 to 2 quarters, and we're not going to see it until Q4 of this year is my bet. But I don't know. Curious, what do you think about that?
Real quick. Sorry, you want to go for it, Sam? I just had a thought on that real quick.
I mean, just real quick. I'm just talking about the outperformance of software versus semiconductors. As the market as a whole, I'm cautious as well, right? Like, I'm not being aggressive to the long side with like calls or anything. I'm still mostly in shares, and hey, my portfolio is about the 200-day moving average, so I'm pretty happy. But at the same time, I think if you're cautious software, I think it's rightful to say that would also mean you're probably cautious everything in general, because there's no way software is going to get hit like it had been since 2023 and 2024, and then semiconductors will continue to propel with leaving software behind. But I don't know. Go ahead. Sorry, Logical.
All right. No, I was going to say, like, I think software that's exposed to consumption models, aka the Datadog, Confluent, like, I think Snowflake and MongoDB won't do much this cycle. Probably not next cycle either. I think, again, the new age of defense names like the CrowdStrikes, the Rubriks, Axon clearly today. You're probably going to see Cloudflare tomorrow as well. But we might delete this part out if Cloudflare bombs.
And totally take this part out.
Take that. Yeah, come on. I mean, I think security is a very safe blanket on this, like, software spend. So, like, I think 35 to 40% of my portfolio now is in security names or the new age of defense. Actually, it's probably closer to 50 now. I trimmed Snowflake. I trimmed MongoDB after I saw Google and Amazon numbers. Like, I think that's not dead money, but I see no world they're going to be aggressive on any guidance, especially in the consumption model, when they see a weak business spending environment in April. And April's not reflecting the earnings reports. The month of April is what's reflected in their guidance, and April has been weak on the channel checks I've been reading, and I do think it's going to be somewhat of a earnings report cycle, and I did some trimming. But I'm going to pass it to you, Logical.
I'm just wondering, I get what Shai's saying too. I look at IGV, it is actually above the 200-day, which is the software index. That's nice to see. But yeah, I mean, we've seen a lot of software names gap down on earnings. I think you have a pretty good read on the industry in terms of, like, seeing that there's, slowing spend, and you're coming into this with pretty rich multiples, I would think, if it needs to be supported by growth and et cetera. So, sorry, were you going to say something?
No, I was going to say also, like, the bounce has been made in software. I'm looking at right now, Snowflake's up 11% this year, CrowdStrike's up 24%, Cloudflare 13%, Rubrik 16%, like, all these software, like, the move has been made. So you have to ask, like, what's next? Like, that has been made.
Agreed. And here's another thought that I wanted to have. When I started this conversation with you guys about the new leaders in the market, because the Mag 7 are lagging, you guys went straight to software, but a lot of the names that I was bringing up were actually not software. I mean, App, Palantir, Hims. What does this make you feel like? It's the retail stocks. And when you kind of overlay that with the concept, like all these charts that show you retail has been buying the dip heavily, and then you kind of look at what's been performing the best, it's been the retail heavy stocks. I wonder if that music will stop at some point. Now that I think about it, because, how are they leading while, the biggest names in the market, the most, structurally sound businesses are the ones that are, kind of floundering below the 200-day.
Actually,
yeah.
Well, Microsoft is near all-time highs. Broadcom's near all-time highs. I mean, there's probably Meta has gapped up pretty strongly since its lows. I see where you're going at. I don't think it's just retail stocks, but I think it's X Mag 7 for the most part. That's been that has been holding the market down because they're the most heavily weighted.
I mean,
guys,
dude, but like, for instance, like HIMS is 100% above its 200-day. Like we're not talking about like just barely gapped up above on an earnings report. Like I'm just saying the biggest outperformance has been the Palantirs. Like, dude, Palantir is at 110. The 200-day is sitting at 65. I mean, it's almost 100% above its 200-day.
Rule 40 score at 83 is kind of crazy.
That's
like a rule of a
fine.
million.
I'm just trying to say that there's a reason. You're seeing those charts that say that there's been record retail buying this dip, right? And the off position, the positioning has been offsides for the institutions that have had to chase this rally. But then you look at under the hood who has been winning, and it's been all this money that's been flowing into the market has actually been mostly going into these very retail stocks, right? Like the HIMS, the Palantirs, the SoFis, the hoods, etc.
It doesn't take that much money to make those stocks go up too. So we got to remember that.
That's the thing. 100%. Liquidity is a pretty big one. But let's get micro, because you guys talked about some specific names. Like we've been gone for a couple weeks. I kind of want to talk about Microsoft. And you guys had a specific.
Yeah. I like that segue. I like that.
No, because I think Microsoft is what caught me off guard, because I've been kind of a bear on not bear. It's just like there's so much fudgery that happens under the hood with Azure numbers that I just don't know what's real. But like Microsoft didn't just post strong numbers. Like it was absolutely it wasn't like one of those hype cycles of like them flexing Azure numbers due to OpenAI. Like it was a full on deployment quarter. You saw Fabric add, like I think it was like 9 or 10,000 new customers in that quarter alone. You saw Copilot usage essentially triple year over year. You saw Copilot, well, it was a 15 million users that Copilot also passed, and you saw like Microsoft Cloud, again the Azure, cross 170 billion run rate with a 20% growth. Again, who knows if that's real or not? But like I think you're seeing Microsoft's architecture kind of fold back into itself, where they're not, AI is no longer a standalone workload. Like it's becoming a multiplier on their core cloud business, and you're seeing them be the spiderweb effect of that. So I do think this Microsoft earnings report was a wow to me. Like it showed that it was misleading because it showed that enterprises weren't slowing down spend, but then we got weakness on Google Cloud and AWS. So
Shai, real quick, sorry, just so that we're informed for the rest of this conversation, I just saw some news come in. Donald Trump tweeted, big news conference tomorrow morning at 10 a.m., the Oval Office, concerning a major trade deal with representative of a big and highly respected country, the first of many. So I just wanted to put that out there. Oh my goodness.
It's going to be Canada. And the market's going to down. It's going to be Canada and the market's going to down.
I want to go back to Microsoft. I didn't mean to interrupt. Just so that we're kind of aware of that context in the middle of this combo.
First off, I tweeted that already as well.
You tweeted it. You're so good at this. You tweeted it while you were talking. And you were looking right at us.
Oh, man.
Anyway, Microsoft. Here's essentially the read-through of Microsoft. AI is accelerating everything else under the hood for Microsoft. Like, it's having a massive spiderweb effect. You're seeing Azure become essentially the control plane of enterprise compute economy. You can say what you want about their positioning with OpenAI, but like it's hitting the other sides of their business effectively. And this quarter proved to me that Microsoft isn't just over earning. They actually are somewhat of, they're in a way underpriced for the shift it's driving, because like I said, they're overpriced because I thought the numbers were inflated, but like I'm seeing so many different elements of their business getting that AI bumped. I'm like, whoa. This is not showing flash. This is not flashing late cycle signals. Like it's telling me these are the early innings of vertical integration that is just beginning for the SaaS, the infrastructure as a service, like GPUs, like models, dev tools, agents, like app layers. Like they are the enterprise software OG, and they're showing all the signs of what it could be for AI under the hood for an enterprise. And I think they are the first hyperscaler to fully monetize the AI stack because of how many different components of their business it's hitting. I'm excited. That got me excited, but I'm gonna pass it to you, Sam, because I know you had some comments on the Microsoft earnings.
I gotta be honest, I was very surprised too, and I think you and I are both in agreement that we were bears on Microsoft for quite some time, being that they were supposed to be the major leader of all the AI move, and then they're kind of getting snuffed out by OpenAI. So on a fundamental basis, that was the case. But also the fact that a lot of it got priced in terms of valuation with Microsoft when it hit 465 at its all-time high. Now it's like a few percentage points away from there. It hit its low around 300, I think 350 or something like that on Robinhood Open on that night and Sunday. But with respect to that, its earnings, I was very surprised as well because the intelligent cloud, which is what they usually use for their cloud numbers, were very strong. But they specifically called out their Azure numbers. They really do that. And that's what I've been trying to look for this whole time was like, well, how good is Azure doing? Because intelligent cloud isn't just Azure. It's segmented across multiple verticals in the company, but they literally call that Azure 30% plus growth. I was like, whoa, okay, this is growing at a much faster clip than even AWS is growing and Google. And Google's not as big as Azure too. So I was very surprised in that. No position in Microsoft. I sold around the 440. So if I were to get back in, it'd be over here. But at the same time, like I fail to see. I know Microsoft is always going to be relevant. They're going to outperform the S&P 500 for God knows how long. They will net like they are the software company of the entire world. And this is kind of supports my theory that software is going to outperform data center for quite some time or semiconductors for quite some time. But at the same time, like, isn't it just so ironic to see how imbalanced the Mag 7 are? Like you look at Meta and Microsoft, they bounce pretty meaningfully, but then you would think that the largest hyperscaler in the entire world would be back at least above 200 at this point, being Amazon. But it's just, think about these two companies, Meta and Microsoft, right? And I know we're probably going to mention Google, but almost all of the mega caps have a lot of risk when it comes to the trade war. And I'm not just talking about macro. I'm just saying this is going to fundamentally affect their core business model. Amazon, e-commerce, they get almost all their products from China, whether it's Amazon Basics and so on.
You can make the argument though. Microsoft's the safest among the Mag 7 because their contracts are all locked in multi-years. It doesn't really affect.
They're also enterprise and they're consumer, right?
Yeah.
And like you're saying, like these companies, not only are they locked in with all these contracts with Azure, but even on a hardware basis, especially with volume licensing as well, like, and especially Microsoft Office or Microsoft 365, like they have the bundling power for all of their products across the board. Teams, I think, is probably one of the worst productivity products out there. Slack is like way better. So that would put in Salesforce in there, but Microsoft can come in and be like, well, we'll give you Microsoft Teams at a big discount, and also the upgraded Copilot at a discount. As long as you sign up for us for like 5 or 10 years, and they'd be like, oh, okay, cool, because we're going to do Microsoft Office anyway, so why not? It's like they have that capability. There's a lot of companies out there that they just got rid of Slack. And you know how much they're saving so much money by getting rid of Slack. But at the same time, a lot of companies keep it because it's productivity efforts. So it's kind of worth that investment. But I'm just saying, when it comes to the bundling power, Microsoft has that in its palm of its hands. It's very difficult to argue a bear case with Microsoft on a long-term perspective. But if you're thinking like short-term, yes, Microsoft was a bear case. But that didn't just catch us off guard, dude. That caught the market off guard. And that's the reason why it bounced and is near back all-time highs again.
I mean, you brought up Salesforce, and I kind of wanted to ask you guys a question, if you guys know this answer. Who's worth more, Salesforce or Palantir?
Palantir. Salesforce is $276 billion.
How crazy is that?
No, that's crazy. That's insane. That's insane.
That's insane.
But Salesforce is only that big because it is inorganic. Okay, like that is one of my stipulations with Salesforce is that I've actually made a statement that I think ServiceNow is going to be a larger business than Salesforce probably within the next 12 months.
Totally. CRMs are gonna be disrupted by agentic AI.
Well, I mean, yeah, of course they're gonna be disrupted, but like Mark Benioff is gonna start acquiring companies, as he said that they were gonna stop. He's going to continue doing it. He did continue doing it. So they will always be around, but it's all going to be inorganic. Like it's very, if I were a Salesforce shareholder right now, I would probably sell and buy something else. But at the same time, I'm not a shareholder, so I don't want it to be criticized on that.
I've
No, I
heard
mean,
some people. I've heard some people pitch Salesforce CRM as like one of the best stocks that they like. It's like their highest conviction, which is crazy to me.
It's because they did a great job acquiring BI tools in the cloud era to sell the platformization spiel. But really, this is my whole issue with Palo Alto as well. Like, you kind of need to be able to grow organically in this new future about the internet right now. So, like, Salesforce has not proven that at all. All they do is acquire BI tools at the expense of shareholder dilution. You guys all know the synergy issues that happen when you make these massive M&A deals. It takes 1 to 2 years to really phase out and like get all the kinks out the way. Why deal with that headache, especially with Salesforce? Like, Salesforce is a blue chip company. I'm not denying that. But blue chips get disrupted when a tsunami comes. Doesn't matter how great of a ship you've been, if you're not consistently innovating your ship to get you through all the troubled waters, like, you're gonna get the tsunami's gonna destroy you. The AI tsunami is freaking real. It is real. It's coming for everyone, and that's why Palantir has a ridiculous premium valuation, and that's why they're worth more than Salesforce, because they're insulated from that tsunami. They are. The tsunami is actually is rising them to godlike multiples because they're safe from all this. They're so insulated from it. Salesforce is not. Like, the CRM, customer relations market space, is going to get disrupted. It's going to be consolidated drastically. You have the big market in Salesforce. You have the mid market in Monday.com and HubSpot. You have the small market in Asana and all the cute little other toys like Klaviyo and Braze. But that space, it's going to get consolidated. And the only way
Hey, don't talk about my Braze, okay? Don't talk about my
Braze
Braze.
is going to get acquired. You're going to be just fine.
Perfect.
You're gonna be happy.
Before the tsunami comes, they're going to jump on someone else's ship that has a sturdier ship to get through the tsunami, and they'll be just fine. But they're not going to be a standalone company. By 2028, you're going to see so much M&A that these software companies that are under $10 billion, I would not be surprised if 5% of them are like still out there higher than they are today. Like, they're going to be disrupted. Like, they're going to look like the initial phase of AI when it becomes a beneficiary for all these software names, when that baton's fully transferred over. They're going to look like everyone's an AI guru. Everyone, because the low-hanging fruit is going to be had with all these software names. But come 6 months after the low-hanging fruit, or come that year, capitalism is going to freaking destroy them. So that's why I'm being very selective of my holdings. And even Snowflake, I love Snowflake. I don't think they're fully insulated from this tsunami. I think they're really protected due to 40% of the world's data is in their ecosystem. But I think you need to be cautious. Software in general is in trouble in the next 5 years because you don't know who's going to survive. But if you show proof that you will survive, like the Palantirs, the Cloudflare, the market's okay with you trading above 150 times free cash flow because you're safe from that tsunami. But
Isn't that crazy?
It's tricky times. It's true though. That's true. Like, that's why I've been like,
Yeah.
I've surprisingly done really well this year in my portfolio, is because I've just been allocating my soldiers towards those really expensive names. And that's a new characteristic of myself. Like in 2021, 2022, like I wasn't like that. I focus on largest delta, whoever gives me the biggest move that's undervalued that can maybe have some kind of vehicle to capture as much alpha in the near term. But like turtle speed, I think going for the companies with the greatest moats that's defensible will get you through the terrain of this macro chaos, and the market will consistently reward those stocks because they deserve to have that premium and they consistently deliver on earnings reports. We saw it today. 2 names. Sam, you and myself own these 2 names. They have incredible moats, incredible monopolies almost. And what they do, actually, I'd say they both have monopolies. Axon and Mercado Libre. Axon is another ridiculously expensive name. I'm looking up their multiple.
They're almost at all-time highs again.
They're trading at 90 times free cash flow this year.
Yeah.
They're up 6% after hours.
When I added them, I was like, I'm probably going to regret buying over here, right? But I wanted to kind of stray away from the usual sectors that I've been buying when it comes to software. And in my belief, I think Axon has a lot. Well, they have Axon Cloud, so they already have that software part of their company. Their margins are pretty good for a company that's selling defensive equipment. But one thing that I touched on, and I haven't even reviewed the earnings call yet. Geez, earnings calls. One thing I want to touch on was AppLovin, and also want to touch on Magnite, because I know, Logical, you have a position in Magnite. We saw what AppLovin had after hours. Like, it doubled in price since those short reports, since the bottom. Basically doubled in price. It's been amazing. Is Adtech back, Logical? Like, and Magnite is up like 12% after hours too. Like, is Adtech back?
Well, we got good numbers from Meta, Netflix, and I know Netflix is mostly sub revenue, but most of their growth is being driven by their ad tier right now. I think it was better than expected, and we started pricing in a really big economic slowdown, and so it's very macro tied. That's what I've been saying for months. Is like, look, this is why you can't be sure about where you're buying ad tech, because the first thing that gets slashed during an economic slowdown is marketing budgets. But the thing is that the hard economic data hasn't actually changed. So everything that's changed so far has been sentiment. So while maybe some people pulled back spend, etc., I mean, people got really ahead of that and started around the uncertainty, just started selling these stocks at all costs. I mean, Magnite was down from $21 to like $8-9 in a month and a half, 2 months.
That's insane.
And that's a 60% drawdown. So now the question is, did we price in too much downside? And I think that's kind of what happened here is like, we started pricing in way too much downside in some of these ad names, and maybe rightfully so. But as we're seeing the data come in, especially their earnings are good. I mean, I can't speak for App. I mean, you can. I mean, I saw the stock is up a lot. I saw someone post a screenshot of the financials. They look insane. They almost look unreal, like how good they are. But like, Magnite came in at above their guide on everything. 15% CTV growth. I thought it was light, but Q1 is like the lightest quarter of the year for, it's a very seasonal industry. And I mean, yeah, everything, they were just above their DV revenue, which is kind of their legacy desktop, etc. That bounced back. I was concerned about one thing, was that they pulled their guide. And I was like, oh, don't do that. And then, but they put a note saying, but we are tracking according to our initial guide provided a couple months ago, which means that we're not really seeing impact. We're just kind of like not willing to give the guide because we don't know if this is going to get worse or better. I just think, like, dude, just stick to the guide everyone else did. But besides that, I mean, yeah, it looks really solid. But me and Magnite, I mean, again, so for the ad names in specific, like in general, we priced in a ton of downside, and we're not really seeing that being reflected in the numbers. So you should get a rip rally back, in my view, unless this trade war extends, in which case you'd probably see it roll back over. But for now, the numbers look good, and I don't see a reason why these stocks are so damn cheap, which is what we were saying on this podcast, was like, hey, look, if this turns out to be like kind of more exaggerated than we thought, like this whole trade war stuff, then Adtech could end up being the best performers of the year. We said that multiple times on this podcast. So I'm hoping that can be the case. But since our last conversations, and this is something that I want to touch on because you bring up Magnite and it's really important, and I shared with you guys the snippet from the call. I just listened to the earnings call today. It's Wednesday, and they just reported earnings. Again, earnings ahead of guidance. Adjusted EBITDA grew 47%. This thing trades at like 8 times adjusted EBITDA for this year. And that's before we get any sort of remedies from the antitrust ruling against Google. And they talked about that briefly on the call. They said, so Google owns 60% of the market share in the SSPs side of the business, of the industry. It's over 60%. And they have to potentially divest. That's what DOJ is asking for, divesting, their businesses, like getting rid of like their ad server business, having it not connected to their SSP business because it gives them an unfair advantage, which the court has ruled against them that they've been acting in an illegal way. So again, 60% of market share, and they're no longer potentially having this like this huge competitive advantage, right? Which has been unfair. And in the call, they basically say, look, for every 1% of market share that we gain, and by the way, mind you, right, Google is a $2 trillion company. The second largest player in this space is Magnite, which is a $2 billion company, literally 1,000 times smaller of a company. We're talking about potential, revenues. These guys have all been fighting for the crumbs after Google takes the entire loaf of bread. Now we're talking about the loaf of bread is up for redistribution. That's a very big deal. And, I think Shai said it, with our chat earlier. Yeah, it could take a year, 2 years, 3 years, maybe. I think we start getting, the remedy court through the end of this year. Maybe there's an appeals process. Maybe that drags out another year or so. But by 2027, we should have a very clear picture of what's going on. And I think that, stocks look forward. And so if you start to price this in, it's going to, I think the reason why the SSPs have traded at such a discount to the trade desk on the other side, which is DSP, we've always said, oh, you'd rather be on the DSP side. SSP side, you're just competing with Google. You don't want to be there. That's why TTD trades at like 100 times EBITDA, 200 times EBITDA, whatever it is. And, Magnite and PubMatic trade at like 5 to 10 times. It's ridiculous. So now that the landscape is changing and they're able to get more of that market share, now you have to think, okay, well then what's the right multiple now that the industry and the landscape is evolving and that these guys are able to, capture a much more meaningful share of the market. So there's two things happening there. One, they're going to get a lot more business. And two, so three things. One, they're going to get a lot more business. Two, that's going to be reflected in their growth. Three, what's the right multiple? So we're going to get a re-rating. So there's multiple things happening here, and you're starting from a very cheap valuation, and they've already been performing really well given the environment that they've been given. And so again, just to sum up what they said on the call, for every 1% of market share they gain, it's $50 million of revenue to Magnite. That would be a 20% increase for them. And they said that every bit of incremental revenue, 95% of it goes to the bottom line. That's freaking crazy. And it could start as of day one of the remedies going into place. So again, for every 1%, they're getting $45 million in bottom line. And they did, I would say my projections are going to do about 250-ish EBITDA for the year. So imagine that. For every 1% they get, you get what I'm saying. It's going to be a huge increase for their adjusted EBITDA. And yeah, it just changes the entire landscape for them. And yeah, PubMatic, same concept. They're even a smaller company. I mean, you're talking about the third largest SSP after Google and Magnite being a $400 million company. And they're about to have the same exact tailwind. The rising tides are about to lift these boats. So imagine what it could mean for a PubMatic, who, by the way, their main their main revenue segment is actually desktop revenue. So if anything, in a vacuum, they are going to see the biggest amount of revenue and earnings gains, in my view, mathematically speaking. Now, does that happen in reality, or does Magnite end up, having a much more competitive product than PubMatic and winning more of that market share? Sure. But when we're talking about a $400 million starting size, and you're talking about hundreds of millions of dollars of potential revenue up for grabs, and that incremental EBITDA margin on that revenue is extremely high. I mean, we're talking about EBITDA that could be added to these businesses that's like tenfold of what they're doing currently. What's that worth to their market caps today? I think I'm going to go out on a limb and say that, and again, the Trump DOJ is really, they're going strong for big tech. I mean, they're putting Meta in the crosshairs. I think he hasn't forgotten that they silenced him for 4 years. So I don't think they're backing down. They've been very clear. They won the case, just flat out. So, yeah, I mean, I'm going to go on a limb and say that these two companies, because of the changing landscape, this was the call option that could have 10x these companies. And I think that they could be maybe two of the biggest winners in the stock market in the next 2 years. And I'll go out and say that. And I've made it about 25 to 30% or more of my portfolio at this point. So, and I've never done that. So that's where I'm at.
Conviction.
Yeah, I've studied these businesses for 4 years, man. And I think this is kind of like the moment. Me and this guy I talked to, I don't know if he's my buddy yet. I'll call him my buddy. Crossroads Capital. Shout out to that guy. He wrote a 26-page paper on the antitrust trial against Google. He wrote it in September 2023. I've been in touch with him ever since I heard him on a podcast, The Business Brew, great podcast. And we've been chatting since. I mean, this guy was nailing it. And he was just saying, like, did all the math, it's like talk to industry experts saying Google really can lose this case. And here's 26 pages why, and what are the outcomes and the results. And I mean, yeah, and they've just been, it's funny because they've been actually keeping their mark. If you look up right now, Google, or use ChatGPT to find out what is Google's ad share in the SSP market, or what's their like market share, it'll say like 9%. And it'll say like it's in line with Magnite, around the same. And it's like, that's because market share is calculated by the number of impressions that you process. So what Google's been doing is having an unfair advantage in determining which auctions they want to participate in. So they're only participating in like the highest value auctions, so that they're processing less transactions and they're winning the highest ones with the highest margins, etc. And they're not even bothering participating with the rest. And that's why all of these other guys like Pubmatic and stuff are out here like processing trillions of transactions to make like fractions and fractions of the revenue. What happens when that no longer exists? And these companies have been learning to fight for scraps and learn how to run lean business models, and they have competitive advantages in their own ways. And now Google's gonna have to go compete with them. And so it just seems like, you know, going eye for eye with these guys. I mean, I'm not saying that Google can't also keep up. I'm not saying Google's gonna lose to them and, you know, they're going to go to 10% market share. No, but it's 60% market share. Can they go to 40%? Still have the majority market share of this market, more or less, like out of all the other competitors? Yeah. But if they lose 20% market share, what does that mean for all these other players? I mean, if Magnite and Pubmatic, which are the next biggest, everyone else is kind of like scattered tiny SSPs. If they get 5-10% each, I mean, it's insane, right? Like that changes these businesses. They can literally like, I don't know. They're multi-baggers overnight, probably. That's kind of my thesis at this point.
So, I don't know, Shai, do you have a response to that? Because I kind of wanted to bring up Google since since it was brought up just now.
No, I mean my response is there's a tailwind. My caveat is I think Google will fight this to the end. It might get pushed, delayed, etc. There might be some other headwinds that occur before that actual tailwind happens, like a recessionary environment. I also think that whenever the pieces on the board move, it opens the door for potential competitors to now go into that space. And because it's more enticing now. So that is another alarming thing where who knows like what other competitor Magnite may experience, because Magnite is cheap right now. I think it could be an easy double. I really do think that. I think hitting $50, I'm like, okay, I think that's tricky. That's what valuation is that for right now?
Well,
They
we're at
are
8 times. We're at 8 times EBITDA right now at
a
like
two.
$13.
Can it be a
So
$10 billion company? They probably have to be a $10 billion company. They probably have to hit a billion, a little over $1 billion in top line growth in the next 2 or 3 years for that to happen. I don't know if they can get that when they're at $600 million right now, growing 10%. So it's gonna be tricky. But I'm rooting for it. I think there's no reason I shouldn't be. But yeah, do you want me to start with Google or you want to start off, Sam?
Well, I mean, I just, there has to be something materially wrong with the company other than the headlines, right? These are headlines that we're seeing. Of course, there's the court cases. Of course, there's a risk. I'm not going to discount that. Okay. And the headlines do mean something, right? But at the same time, if we're thinking about what Google is, right? Not only are they the third largest hyperscaler in the entire world, growing at about 30%, they're almost half the size of AWS. They have one of the best chatbots in the entire world, Gemini. Okay. And they're going to constantly improve that. On top of that, they just acquired Wiz. Okay. So they're getting to cybersecurity. On top of that, they have one of the largest development platform communities in the entire world. Okay. They basically run that entire show. On top of that, they're in smart home as well. On top of that, they have an operating system in their own phone. There's a lot of things about Google that it has going for it other than YouTube and other its web search, okay? Or web advertising or Google search advertising. I don't want to get into Google networking because that business is it's just there, right? So the company's trading at an 18 trailing PE. Historically low as far as its valuation that it's had for a long time, okay? The market is just a few percentage points from its all-time high. Google has barely even recovered since its low in April. Okay, so I'm not trying to set up a play here or anything. I'm just trying to put things into context, saying that if there are bears with Google, do you think this company is going out of business? Because at this point, that's kind of what 10% down and already merely, I don't know what if you even call this a bounce. Do you think Google is going out of business? Because that's where the argument is seriously headed. And even if they get rid of Chrome, and even if they get rid of part of its search business, I think that those other businesses alone, along with its moat, I think that really speaks for itself in its current valuation. Now, well, before I get any criticisms on that, I haven't decided what I'm going to do in my position yet. Okay, only because it's not that big a position in my portfolio. So, there's a lot to know with this. Like, I'm not even an expert in exactly what's been happening at Google for the last few weeks, mostly because there's been a lot happening in the last few weeks. But what is your take on the situation, Shai?
So first off, I'm shocked that you have such a small position in Google. I feel like if it's over $1 trillion valuation, it needs to have a hefty component of your portfolio. Usually anything under 3% for me is like speculative.
Well, I've
I'm
trimmed
curious.
it. I've trimmed it.
Oh, you trimmed it? Okay.
I've trimmed it mostly because I wanted to get more into Meta. So I have like almost a 2% position in Meta. I got back into Meta near its April lows, but if I could switch those position sizes or put all of it in Meta, if I could choose between Google at 140, which is really close to where it is right now, versus Meta at like 460, which is where it was in its lows when I rebought it back in, I would just put it all in Meta. But Meta has run quite a bit from there. So there's a lot of assumptions baked into there.
So for Google, it's tricky. First off, Google their current valuation is an absolute paradox. So the reason I say that is, on one hand, it looks like dead money. Opportunity cost is very real. There's some growth fears. Search is 55% of their total revenue. The AI search overhang is very real. And a multiple that refuses to budge, doesn't matter how undervalued it is. Under 20 times earnings that's cheap. But there's a reason it's cheap. Like the reason it's under 20 times isn't unwarranted. Like ChatGPT, OpenAI, like they changed the narrative on search. Like now some of the moats that once looked impenetrable feels uncertain. And now the market isn't just discounting the earnings, it's discounting the entire framework that investors used to value Google for the last 10 years, 15 years. So like in order to stay bullish, I really think that you need to look under the hood, like what Sam said. I think you have to acknowledge that the consumer side of their business is softening, but their infrastructure side of their business is absolutely hardening, like all the call outs on cloud, cybersecurity. And I did the back of the napkin math. Cloud is a 50 billion run rate. Rule 40 score of 46. I'm not going to do price of sales because I was premature to do 20 times price of sales. Logical called me out on that. It was a good call out. I think if a Rule 40 score is at 46, I think it's fair to trade at 40 times your earnings if you have a Rule 40 score of 46. I think that's fair. So put that alone. That's a $70 Google's price is $150 right now. Their Google Cloud is $70 by itself. I would put the argument that YouTube alone is $25 to $30. So now you're at, again, roughly $100. Now the delta between 150 to 100, now that's when the cannibalization of their search business comes to play. And I think nobody knows how much that monopoly is going to erode. I don't think it's going to be as drastic as everyone else says it will be. But even if it goes from 90% market share to, I don't know, 60%, that's where they're printing their cash. So that's going to be a substantial bottom line. It's going to be a massive margin compression issue, and it's going to be, you're going to invest right now, you have to believe that their multiple will expand, and that comes with reacceleration on the bottom line. And I just don't think that's going to happen anytime soon. It's going to be a slow drain, and that's the paradox of Google. And I think opportunity cost is very real. If they show signs that search, it's not going to happen next 2 or 3 years. It's actually going to happen maybe in 5-7 years, and it's not going to go to 60%. It's going to 70-75%. By that time, in 2 or 3 years, at this rate, their infrastructure side is going to make up substantially more than their search side. And I think this narrative issue won't be that much of an issue anymore. But that's going to take some time to phase out, and you have to be willing to sit in your position for who knows how long. An opportunity cost is going to come in play. So yeah, it's a paradox. I wish I had a better answer for everyone, but I just think that you have to believe that search won't be disrupted to invest right now because the fundamentals will change. I really wish they would break up their search business separately. I really would love to acquire Google with the other segments, but when you have 55% of your revenue just about to get disrupted due to the AI tsunami, a lot of people don't want to be on that ship. You just don't know what's going to look like after that tsunami hits. And that's fair. It really is fair. So it's something you have to ask yourself that. And I think this is also not even factoring Waymo. Like, I think you're getting Waymo for free as well. Like Waymo, who knows what the price for Waymo is? Like AVs, autonomous vehicles, is a very real thematic. So I think Google's to start a position here. I think it's very fair. I don't love the argument that's undervalued at 18 times earnings because that's going to drastically change. I really like the argument of sum of parts, figuring out what cloud's worth, figuring out what YouTube's worth. No world you can figure out what Waymo's worth, but doing the sum of parts and then putting a fat multiple, whatever the multiple you want in the search business, and there you go. Do that math. I don't know. What do you think? I know, Logical, you have different interpretation of what Google's.
I also want to add that they're buying back a lot of its shares, and they're also giving dividend. Like
Well, they're doing what the Apple move is, financial engineering.
Yeah.
For sure. Yeah.
Yeah, I mean, I think that's my thought at this point is that a lot of these mega cap tech companies are just going to end up going. I mean, as soon as you announce a dividend, as soon as you start doing this financial engineering, EPS engineering, you just kind of become a stalwart, which is fine. I think that you can continue to hold these companies in your portfolios, but like, we're growth investors and I don't see the growth, and that's the problem. And so like, sure, cloud is doing well. Got it. But yeah, I mean, the rest of the business, like you said, headwinds, and I'm not saying I'm a Google bear, but it's kind of like one of those situations where it's like opportunity cost. I think that's kind of what sticks out to me the most is like, why own this when I can own a lot of other things? And like, I'd rather own Amazon for sure. Amazon's my favorite big tech. We've talked about it all the time. I mean, we all basically agree on that. It's, your guys' is like basically largest holding more or less. So yeah, I just don't really see, like, I just don't see it. I don't know. I don't have more to say than I'm also just not interested in large companies, generally speaking. So it's even a tougher sell for me personally. But yeah, what do you think, Sam?
I mean, Amazon used to be a large position in my portfolio, like 20%. Now, I don't want to say these numbers out loud, but now Mercado Libre is really getting up there. Yeah, we are growth stock investors, and I guess there was a time when Google had the momentum, and it was a very great momentum trade, but it's kind of fizzled out. I'm not saying it can again, because like Google has, if you look at Google's chart, it has these ups and downs, like very drastic ups and downs. Like the terms you guys use, like stage 4, stage 3, whatever, distribution, accumulation, whatever it is, like, it has these periods. I'm not saying that's going to justify what's going to happen, but I wouldn't be surprised if Google is back near all-time highs in maybe a year or two from now. And there could be every single case out there. But you guys do know this, that things can change in a minute. Narrative can change in a minute, right? And it literally just takes like a couple headlines for it to just propel back to all-time highs along with the market. I'm not counting on that for that to happen, but that's where the position sizing comes in. That's why Google is only 2.5% of my portfolio and not like 5, 6, 10%, because it's mega cap. Yeah. But at the same time, it's like, I'm trying to outperform the market here. If Google does perform on par with the S&P 500, then why would I just not buy the S&P 500 at this point? Right? It's a lot less stress. I don't need to follow it. And plus I'm going to be getting the best companies in the entire world actively managed. Like, why wouldn't I just do that? So that is where the opportunity cost comes into play. Am I just trying to perform the S&P 500? Or am I trying to outperform the S&P 500? If it's the former, why are we here? Why are we doing this? this is a lot of effort. This is not fun. Well, it is fun. In a sick way, it's fun. But at the same time, it's like, why would we be doing this if we were just looking for 8% CAGR over a long period of time? That's not why we're here. So at that same time, that's the question that I ask with every single company that I'm buying. Is this going to outperform the index or a general ETF that this company trades in? And the answer is yes. Then that's when you continue with deciding if you're going to own this company or not. All the positions in my portfolio, I believe, will vastly outperform the S&P 500. And that's what comes into play with Google is that, like you're saying, Shai, 18 times trailing PE is the PE right now, but that can drastically change, and especially if the story changes. The story is changing, and that's when we look at companies that we own and we think to ourselves, like, long and hard, we think to ourselves, do we want to continue holding this company? That's why it's like the buy and hold mentality is like, oh, you buy and you forget about it, which is nothing wrong with that, right? Like Buffett has basically done that with Apple and has basically contributed to most of his gains for like the last decade or two. But at the same time, it's like, as retail investors, we don't have a multi-billion-dollar, $100 billion portfolio where it's like we could just sit in Apple for a few years, whatever. Like, we got to think about this, man. We're putting a lot of new money into our portfolio every single or every other week, and we want to see it grow. And you know what? We also don't want to handle the risk. So that's something we need to think about. Sorry to go on a little bit of a tangent there.
No, I mean, it's helpful. Like, look, I'm a snowflake shareholder. It's been brutal holding that stock past 2 or 3 years. I don't love it. And I've been pretty, my strategy has been different past like 6 months, and it's bearing fruit. Like, I'm going towards the names that are clear winners, and those positions that I think are deserve a re-rating or are in the process of that, they're not going to be a top 3 position for me anymore. They're going to be part of my core, earn your way up. But the top 5 names in my portfolio, they're names that are winners. They're monopolies. They don't have to go through a re-rating. They got to see at the table. And now it's bearing fruit because they're just compounding. So that's a new skill I learned. But we're at the top of the hour. This was a great Sweet 16 that we had. I appreciate you guys all joining my Sweet 16 party. I can't wait to see what gifts you guys give me after this episode's wrapped up. Now, I think the things are not as bad as they were a couple weeks ago. Just remember that, guys. Like, we have a sandbox of risk to play around in now. Tomorrow morning, we're going to see who the first country is that's going to be the official trade war signee. I think it's going to be Vietnam, and that's going to be a fire burning in China's tum-tum when they see that U.S. and Vietnam got in agreements. Curious on how that's going to escalate. Hopefully it's not like some random country like Australia, but that's gonna be curious tomorrow morning. We got some earnings as well tomorrow. We got more earnings next week, but let's see if we can clear the 200-day moving average. We're like a couple percentages away, so like it won't take much of a catalyst for us to blow through that, and I think that's when it's gonna start getting constructive. But I'll pass it to you, Logical, if you have any final words before we sign off.
Yeah, I mean, look, I don't think we're out of the woods yet. I do think that the market has been losing a little bit of steam. I mean, we did rally like 20% off the lows, which is crazy. So, or whatever it was. And I think you can just basically use technicals as a way to understand if it's risk on or risk off. And like, as we lose moving averages, like the 9 EMA, 21 EMA, 50 day, whatever, 20 day, like those are lines in the sand to go a little bit more risk off, or like, maybe lighten up some exposure. And that's kind of what I'm looking at right now is like, for the time being, it seems okay. And then, people will be like, oh, well, why don't you just reduce exposure before? It's like, yeah, maybe that's the right idea. But for the time being, because it's kind of hard to say, right? Like, what happens if all these tariffs get walked back and it's a 10% deal? And then it turns out to be a situation like 2018 where you had a, 20% drawdown and then more or less a recovery. And, maybe we get, FOMC came out today basically saying, oh, we're going to be data dependent per usual, right? No shock there. But I mean, what happens if, CPI data comes in cold, like 2.2%? I don't know what it's set to be, but, closer to 2%. What happens if we get one more, what if we get like an unemployment tick up? I mean, they're cutting rates, right? So like they said July, I mean, it seems like July is the likelihood, but it could be June. My point is a lot can change pretty quickly. And so I'd rather be reactive in this environment than proactive. It's kind of what I've been talking with friends about, and like they tell me like, why wouldn't you just do do that now? Why wouldn't you like think it's like, well, I can just react, right? Like, I mean, we watch these things pretty closely and yeah, I mean, I don't know. I'm going on a trip in a couple weeks, so maybe I should lighten up a little bit before then, or at least not go too crazy on anything. But other than that, I mean, yeah, you can basically just kind of set rules for yourself, and that's all. But yeah, it was a fun episode. I look forward to the next one. Sam, off to you.
Um, I mean, there's gonna be a lot to talk about next week. There was already a lot to talk about today. And we're gonna start focusing on what we really like doing. That's focusing on the micro. So hopefully we get that handed to us as a birthday gift or Sweet 16 gift for Shy. Happy 16th birthday. Um, anyways, that's really all I can say. It's we're still on the early start of software earnings, so this is going to continue being a very busy season for me, and I have not caught up with almost all the earnings. I haven't even went through Reddit earnings yet, and it has gone nowhere since before the earnings. So, you know, it was nice to look at Reddit up like 20% after earnings. Then all of a sudden, boom, they talk about Google cannibalizing their revenue. And just like, oh, crap, I don't know what to do. Anyways, we'll see what happens, man.
Awesome. Well, see you guys next week.